Brad Williams, Frugal Finance Investing. When you invest, there's a certain level of risk associated with all investments. The question here is, well, what is risk? All investments carry some degree of risk. Stocks, bonds, mutual funds, exchange traded funds, gold, commodities, crypto, real estates, non-tangibles, tangibles. There's a level of risk in everything we do. Therefore, these various instruments can lose value, even their entire value, if market conditions sour. Even conservative, insured investments such as certificates of deposit issued by a bank or credit union come with inflation risk. That is, they may not earn enough over time to keep pace with the increasing cost of living. What is risk? When you invest, you make choices about what to do with your financial assets. Risk is any uncertainty with respect to your investments that have the potential to negatively impact your financial welfare. For example, your investment value might rise or fall because of market conditions. That's considered market risk. Corporate decisions, such as whether to expand into a new area of business or merge with another company, can affect the value of your investment. That's business risk. If you own an international investment, events within the country can affect your investment. This is a political risk and currency risk, to name two. There are other types of risks. How easy or hard is it to cash out of an investment when you need to is called liquidity risk. Another risk factor is tied to how many or how few investments you hold. Generally speaking, the more financial eggs you have in one basket, say all of your money in a single stock, the greater the risk you take, concentration risks. In short, risk is the possibility that a negative financial outcome that matters to you might occur. There are several key concepts you should understand when it comes to investment risk. Risk and reward, the level of risk associated with a particular investment or asset, typically correlates with the level of return the investment might achieve. The rationale behind this relationship is that investors willing to take on risky investments and potentially lose more money should be rewarded for their risks. You can learn about risk associated with specific investments by going to the risk tab for each investment listed in our investment product section. I have videos on all of this stuff, so check it out. In the context of investing, reward is the possibility of returns or profits. Historically, stocks have enjoyed the most robust average return over the long run, just over 10% per year. It depends on the time frame here. If you go back to 1928 through today, this is going to be about 12% per year pre-tax, followed by corporate bonds around 6% annually, treasury bonds about 5.5% annually, cash equivalents or short-term treasuries 3.5% per year, gold about 9%, and then real estate is just about that also. The trade-off is that with this higher return comes greater risk. And although stocks have historically provided a higher return than bonds and cash investments, albeit at a higher level of risk, it's not always the case that stocks outperform bonds or that bonds are always lower risk than stocks. Time can be your friend or foe based on historical data. Holding a broad portfolio of stocks over an extended period of time, for instance, a large cap portfolio like the S&P over a 20-year period, significantly reduces your chances of losing your principal. However, the historical data should not mislead investors into thinking that there is no risk in investing in stocks over a long period of time. For example, suppose an investor invests 10 grand in a broadly diversified stock portfolio, and 19 years later sees that the portfolio grows to 20 grand. The following year, the investor portfolio loses 20% of its value, or 4 grand, during a market downturn. As a result, at the end of a 20-year period, the investor ends up with a $16,000 portfolio, rather than the $20,000 portfolio she held for 19 years. Money was made, but not as much as if shares were sold the previous year. That's why stocks are always risky investments, even over the long term. They don't get safer the longer you hold them. This is not a hypothetical risk. If you plan to retire in 2008-2009 timeframe, when stock prices dropped by 57%, and had the bulk of your retirement savings in stocks or stock mutual funds, you may have had to reconsider your retirement plans. Investors Should also consider how realistic it will be for them to ride out the ups and downs of the market over the long term. Will you have to sell stocks during an economic downturn to fill the gap caused by a job loss? Will you sell investments to pay for medical care or a child's college education? Predictable and unpredictable life events might make it difficult for some investors to stay invested in stocks over an extended period of time. Managing risk. You cannot eliminate investment risk, but two basic investment strategies, asset allocation and diversification, can help manage both systematic risk, risks affecting the economy as a whole, and non-systematic risk, risks that affect a small part of the economy or even a single company. Hedging, buying a security to offset a potential loss on another investment, and insurance products can provide additional ways to manage risk. However, both strategies typically add, often significantly, to the cost of your investments, which can eat away at returns. In addition, hedging typically involves speculative, higher risk activity such as short selling, buying or selling securities you don't own, trading in complex products such as options, or investing in illiquid securities. The bottom line is that all investments carry some degree of risk. By better understanding the nature of risk, taking steps to manage those risks, you put yourself in a better position to meet your financial goals. In addition, knowing your risk tolerance level, the amount of investment risk you're willing and able to accept, can help you make investment decisions that are right for you. What does that mean? When you're young, you have a chance to make up any potential losses. Typically, when you're younger, you're a little more speculative. The men like to play the options game in this new era. Subsequently, they're going to find that, ouch, yeah, it was easy money for about a minute and a half. And then they end up losing more than they made. They can make that up. But if you're 65 years old, you're probably not playing that options game anymore. If you're younger, you're probably going to look at growth stocks as opposed to an income-oriented type, mature, Target, Coca-Cola, GM, those types of stocks. So it's just a matter of your risk tolerance. Do you want to park some money in treasuries for the income or for uncertainty in terms of maybe political risks? A lot of uncertainty, a lot of strategies involved depending on many factors. So comment. Let me know your strategy. Let me know your experiences. Share with others what's working for you and your tolerance of risk. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.